This, our next guest, helps manage one of the best global equities funds according to data that we keep here at Bloomberg. Here to tell us how to best position your long-term investments is Matt McLennan. He's portfolio manager at First Eagle Funds. Thanks so much for coming in today, Matt.
Thank you.
Gold is your biggest holding. It's flying high today. How much further can it run?
Well, at First Eagle, our focus has always been on avoiding the real impairment of capital, and gold is part of the equation for us. We're primarily investors in business, but we recognize we live in an all-too-human financial architecture, and so gold for us is a potential hedge against that. And I think we're in a world today where people realize that if they own cash, they have to take credit risk, both in the form of government or banks. And with government, with gold, obviously gold as nature's currency can't be printed, and it's no one's liability. There are therefore sort of no bounds on where gold can go to based on how bad the perception of fiat money is. But on the flip side, gold can also move lower if corporate profits improve tax revenues and the like, and government discipline is put in place. So we actually don't have a directional view on gold. Gold is held for us as part of a portfolio where we like to balance our exposure to investment in business with some amount of capital in store to take advantage of market surprises like this.
We were just showing that gold's up almost 12% over 6 months. You said you don't have a directional view, but how much of your portfolio does it make up?
Yeah, we have roughly 6 to 7% of our portfolio in gold bullion, and we have another 5% or so of our portfolio in gold equities. Any more than that, and it starts to become a directional view, it's primarily there as a potential hedge for us if the system encounters problems.
Okay. Well, and looking at your other holdings, you've got large positions in 2 Japanese companies. And it's interesting because these days when you hear people talk about excitement in Asia, it's usually to the exclusion of Japan. I mean, you've got cheap stocks there, but there are concerns about a new administration, a new prime minister, stronger yen, a bit of a struggling economy. Why are you betting on Japan?
Well, the key is that we're not betting on Japan. The key is that we've identified good businesses at good prices. If one's goal is to avoid the permanent impairment of capital, one has to own businesses that can grow in line with nominal GDP over time.
And one of them is a bicycle company.
That's right, Shimano, for example. And Shimano is the world's leader in bicycle brakes and cogs. It has over 60% share of that market. It's a stock that's actually done very well the last couple of decades, despite a very difficult situation in Japan. We own Shimano because it's a good example of what we look for: a conservatively run business, no debt, net cash on the balance sheet, and a dominant market position. If you own a portfolio that has these kinds of eclectic royalties, as I like to refer to them as, and you own some gold as a potential hedge, we view that as the right way to preserve capital long term and try and avoid some of the kinds of issues we see going on in the world today.
Well, what does Secom do?
Well, Secom's in the business of providing home alarm and security services. It's almost like a cable company, except rather like Shimano, they have no debt. If you're looking for a margin of safety in your investments, it helps to have not only a low price, but no contingency in the capital structure and a conservative management team, and Secom embodies all of that.
So it's interesting to see you take, 2 bets on very specific instances in Japan, but you say you're not betting on the overall economy there. I mean, where do you have sort of a directional view?
Well, we primarily don't take directional views. It sounds unusual, but we've made money over time by avoiding the landmines. And our approach has been to seek out areas or securities where we can find a margin of safety. And we're flexible enough to be out of big sectors of the market, being out of tech in the late 90s, being largely out of financials in 2008. So it's often what we're out of as opposed to what we're into that has helped determine the portfolio over time. And what we do invest in, we like to invest in with a margin of safety and to keep some gold in reserve. So
tell me about the concern that you do have about credit growth in China.
Well, we have been somewhat concerned about credit growth in China. We think it's been one of the largest monetary experiments on record. Credit growth in China, if you look at the growth in M2 over the last decade, has been north of 20% annualized in dollar terms and has accelerated in recent years. This has led, we think, to a great deal of malinvestment. China is almost half the world's steel capacity and cement capacity. That worries us.
That does worry you.
Yep.
All right. So somewhat of a directional view there. A little concern in China, at least.
Prudence.
All right. Thank you so much for giving us your top picks. I appreciate it.